Boom. All right, what's up, you guys? It's Royce Jacob. Welcome back to the channel. In this fundamentals focused video, I want to talk to you guys about why growth stocks and cryptocurrencies have been getting so beaten down lately, and while we go over our reasonings behind the downside, we'll also do our best to speculate and guesstimate as to when we might see things start to reverse and all of that downside that we've been seeing recently turn back into the upside that we all desperately want to see. All right, so as I just mentioned, this video will be entirely based on fundamentals. You guys know we spend a lot of time looking at charts around here, but in macro environments like this, where there's not much rationale present and there's a lot of fear present, it's especially important to prioritize not just the fundamentals, but the market psychology and the investor sentiment psychology, which we'll be talking about a lot today as well, on top of the fundamentals like raising rates and whatnot. All right, so again, charts obviously hold their place, but at times like these, the fundamentals of psychology just mean a lot more than the charts, at least in my opinion. And this is what I want to go into the weekend with, okay? So, also, little PSA before we really dive in. I just want to say, you guys, I know the past week was rough. We did not kick off 2022 on the note that I hoped we would. I know a lot of you guys want more upside, and that's just the reality of the market sometimes is you get curveballs, little asteroids come at the markets, okay? And that's kind of what's happening now with the raising rates. And it's easy to get dismayed. Heck, not just the past week, but the past month or two has been especially rough for cryptocurrencies and growth stocks. Again, these hyper growth sectors that we know and love so much around here on the channel. Again, cryptos, biotech, EVs, green energy have just been getting torched. And as a matter of that, when you're involved in those markets, and again, that's what we focus on here around, like that's what the Waves fan focuses on, right? Is those exciting revolutionary sectors. And unfortunately, those have been getting absolutely rocked for the past couple of weeks. Again, at times like these, it can be hard to lose track of the fundamentals that may be bullish on these stocks and these companies in the first place. So that's why it's especially important to remind yourself of the fundamentals, you guys. Keep your eyes on the prize and do your best to not let the decreasing number you see in your accounts, in your brokerage accounts, in your trading accounts, dismay you that much. Never base your happiness upon that number, you guys. I know it's hard to execute and it's easy to say. Trust me, you guys, I get bummed too on bad days, especially knowing I have to come to you guys, talk to you guys about the downside. It sucks to be a bear. It's always funner to be a bull. But at times like these, again, you just have to stay rational, just keep your eyes on the prize. And again, never base your happiness on the number in your account balances. And again, just remind yourself of the fundamentals that made you bullish on the plays that you're still holding in the long run, okay? But regardless, again, recently things have been rough. We will be talking about a few different reasons and a few different metrics. Take a look at a few charts that definitely that I believe describe and kind of give you guys an image, a visual of what's been happening lately. And the first tab you can see here really plays into the psychological aspects of these hyper growth cycles or bull cycles, okay? So this is something that we'll get into as we read through certain things that I want to read through. Let's go over all of the tabs I want to share with you, and then we'll kind of dive into each one as I feel it's organic. You guys know I one shot, one kill these videos, no editing. So I'll do my best to compose these thoughts as eloquently and articulate them as best I can. But again, forgive me if this is a little all over the place. Hopefully I can just relay the general concepts that I want to relay to you guys through properly, okay? So this is obviously, as I just mentioned, a psychological cycle of hypergrowth cycles or bull markets. Next to this, we do have a fear and greed index for Bitcoin. This video isn't specifically about Bitcoin, but this does play into, Bitcoin cryptocurrencies are very closely correlated to hypergrowth sectors of the equity market. So tomato, okay? And this does play into just, again, general investor sentiment and market psychology at this moment in time in this current market environment. And then we do have this chart that I want to share with you guys. This is interesting, and this isn't a chart that I've shared on the channel before. I do keep an eye on this, but this is the first time I'm sharing it on the channel. This is large cap versus small cap stocks. And obviously, large caps, the big players, the value stocks, Apple's the perfect example of this. Up until a couple of days ago, have been absolutely ripping, while small caps, while these hyper growth sectors have been getting just annihilated over the past few months. And then along with this, we do have just, again, these charts right here, which I really want to focus on as well. And this is just showing larger caps versus small caps. And the reason I want to talk to you guys about this is because I do believe at some point in the near future we will see some sort of mean reversion, and these come back to a natural balance that they usually that they tend to follow historically. Okay, so we'll take a look at these again when necessary, and then to close out the video, I do want to read through this amazing article that I read through yesterday from CNBC Pro, titled "Why Speculative Tech Stocks Are Getting Hit and When It's Likely to End." So the first part of the video, we will be prioritizing the market psychology, or the psychology of the general investor, the retail investor base primarily at this point in time. Again, base kind of this rationale behind psychology, because so much of what we're seeing now is just fear, and again, that's where the fear and greed index does come into play, and I will explain this a little bit more as we really dive into it. But again, there's a lot of fear in the markets, you guys, so we're going to be focusing in kind of the first part of the video, whenever we get through it, on the market psychology, and then we'll close out the video here, and this goes into more specifics, more fundamental macroeconomics in the rate raise. Again, the Federal Reserve, good old Jay Powell, they've decided to raise the rates a little more than a lot of people expected. I mean, you guys, everyone knew these were coming, and it's surprising that even though they are going a little harder than most expected, that it's taking this type of toll on the markets overall and growth sectors as well. So we'll read through this. This goes over, once again, more fundamentals as opposed to psychology, and we'll just close it out here reading through this. It's a decently long read, so just chill, you guys. And again, this video going into the weekend with this, I do just want to say I do think next week things will start to turn up. And again, we'll rationalize that as we move through the video. To kick it off, though, I do want to read the intro to the newsletter that I sent out this morning, because I do touch on this. I did include that chart that we're going to be looking at here, this bad boy, and of course we will jump into this when necessary. But I want to read through this because this just this just summarizes my thoughts on the macro environment in a way where I won't have to remember it. I can just read through it because I just wrote it this morning. Okay, so happy Friday, fam. It's a beautiful day outside of the markets, but unfortunately, we're closing out this trading week with more of the same, and that same is red. Again, you guys, it's easy to be bummed out, but go outside, enjoy the beautiful outdoors, do whatever makes you happy, spend time with family, friends, loved ones. Ultimately, that's what the money's about. Again, this is our game, so it sucks when you're on the losing side of a trade at any time. But again, if you want longevity in this game, if you want to be here for a long time, trust me, I've been in this position multiple times before. The main thing is you come out the other side and you can withstand the winners. Okay, you need that callus. You need that callus, and that's why it's important not to give up at times like these, but reassess and reevaluate your position so you can again, adjust accordingly moving into the future. Anyway, both the crypto and equity markets are continuing their descents upon fears of raising rates. As far as general market fear and negative investor sentiment is concerned, I can't imagine that things get much worse from here. Bitcoin is at an 18, which is extreme fear on the fear and greed index. If there were a way to gauge fear and greed amongst growth equities, I'd imagine that it would be even lower. So let's jump in here because I feel it's necessary. Now we'll talk fear and greed. Okay, so the fear and greed index, multifactorial crypto market sentiment analysis. There are a multitude of factors that go into the fear and greed. You guys can just go Google fear and greed index. I think CNN Money invented the fear and greed index for the equity markets. So go check that out. I think there's 7 or 8 different factors that dictate fear and greed. These are obviously technical factors, technical indicators. But regardless, the higher the fear and greed index is, the more greedy people are feeling, and the lower it is, the more fearful people are. And right now we are in extreme fear. You can see here today, we were in 18, extreme fear. Yesterday, even worse, 15. And then last week, 28, fairly fearful. And that fear did obviously snowball into extreme fear. And when we're in times of extreme fear, historically, those are usually good times to buy, especially for the long term. All right, you guys? So when others are fearful, you should get greedy, and vice versa. That's wise words of the great Warren Buffett, who has been absolutely crushing it. Everyone was talking shit about Warren Buffett last March, February, when all the small caps are ripping and this guy's investing in Apple and stuff. But when you look at the year over years, come on, it's Buffett. Okay, so regardless, you guys, the markets are extremely fearful right now. And again, historically, not to say that things can't get worse. Like fear and greed can get down to 5, 10, okay? Things can still go down. Things can get extremely fearful. And as we jump into this, you can see panic. There's fear, anxiety, panic, and then depression. So we'll keep on reading here, you guys, but just keep in mind, historically, when we're in levels of extreme fear, if you have fundamental conviction around something, Bitcoin in this example, if you believe in the long term of Bitcoin, if you believe in Bitcoin as a safe haven, as the best store of value asset, as the best inflation hedge of all time, like I do, then right now it probably isn't a bad time to establish a greater position if you're not content with your current position, okay? Not financial advice, that's just obvious, okay? So that's the fear and greed index. Let's move back here, and then we'll talk about below. Attach a screenshot. General psychology that bull markets and hype cycles follow. This is a very important pattern to be aware of, and also one you'll have experienced personally if you've been in the crypto market for a few years. Remember, during hype cycles, psychology plays a much larger role than technicals, which again, why this video today, I felt compelled to make a pure fundamental focused video, okay? So again, let's jump into this. And again, this is something that all of you, if you're around in 2017 or even before, like 2014, prior to that, 2017, this was a very, very real cycle. Move my fat head so you guys can kind of see the full cycle here. But again, you guys, this is classic. This is something you all would have seen not only in the crypto markets, but last year in January, February, March, Q1 of 2021. One of the best times the Waves family's ever seen. There was Riot, there was all these plays, just growth sectors overall. And we'll see that as we dive into these charts, okay? But growth sectors as a whole saw this exact same cycle. The parabolic rally after that, this is the second wave. This is a real second wave. You guys know the two-wave theory. The first wave comes right before this, which is attention. And I would say that's the only difference. Before the parabolic rally, there's that first little wave that brings attention and volume and general interest, and then comes the real hype cycle, which is hope, optimism, thrill, euphoria when you're at the very top, when you're seeing all those zeros, all those extra zeros in your brokerage accounts, right? You made the right call options, you leveraged some shares and made some great plays. See those zeros stacking in your brokerage accounts. That's the euphoria. You think things can't go down, and then boom, you get hit with the first one, mixed feelings. You're like, shoot, high or low, it's just a high or low, it's all good, right? You see that bounce back, you see the dead cat bounce, followed by lack of momentum. Again, you guys, if you're not a buyer, you're a seller, and that's something that's very important to remind yourself during these cycles. If you're not a buyer right now, you should probably be a seller, okay? And that's just, again, that's just investing 101 right there. Followed by boom, crash, anxiety, panic, and then depression. And that's where I think we are right now. We'll close this out right here. When it comes to growth equity specifically, I think that we're currently somewhere between the panic and depression phases. Most investors who would have sold off their positions likely would have done so by now. There are a multitude of very attractive names that hit 52-week lows as we close out the first week of 2022, I'm sorry, and I'm feeling sharky. Again, you guys got to be a shark in these bloody waters. When there's fear in the air, those who can remind themselves of the macro fundamentals and think rationally will benefit. Patience pays off, you guys. Patience pays. I still believe that things will turn around once the dust settles. Therefore, it took advantage of some of the pullbacks we've seen across the market today. Also introduce a new face. And again, you guys, there's so many opportunities out there if you can keep your eyes on the prize, as I was saying in the intro. And again, you guys, it's hard but necessary to have the stomach that can withstand times like these. Days, weeks, months, heck, like winters, right? It sucks. But again, you have to remind yourself to keep your eyes on the prize. And that's why, again, it's so important not to tie your level of happiness or your baseline of happiness to the markets, to execution within the markets. Everyone has bad times and everyone has good times, okay? And the good times will come. The sun shines brightest after the rain. You guys know the little cliches there, right? So again, you guys, just don't get broken down and stick with it, as I was saying. A little PSA. Thank you for attending my TED Talk. Anyway, you guys know the drill. If you do want one of these bad boys, if you do want my daily email newsletter, this is part one. This is the intro where I explain the trades I made, go into the new faces of the portfolio, go over some old faces, ones that we talk about here on the channel, but also some new ones again. And you do want to know exactly what literally my entire portfolio consists of, okay? That's going to be the first link down in the description box below. 15 bones a month, $40 for every 3 months. Really appreciate it if you guys check that out. Put a lot of my time into making this worth all your money. You also get the exclusive Sunday stock watch every Sunday, just a video exactly like this, but I make the link private and send it out through the email newsletter. So again, it really means a lot if you guys check this out. But if not, no worries. I appreciate you watching right now. That was a late plug, but that's all right. We got through this, you guys. Again, we'll go through this at the end. Actually, we'll go through this pretty soon because we've pretty much gone over this, you guys. Again, just screenshot this if you want. Keep this in mind, though, because this is something that applies in every single hype cycle that you'll ever play, is this exact cycle. Again, when you see it, even when we go over plays like Mana, Sand, Render, these ones that have these plays that have gone parabolic, at least most recently in our books, right? These plays that have gone parabolic, following fundamental hype and momentum, where they're like the hype is warranted, the hype can be justified. They all follow the same thing. They all follow what? They all follow that 360% move to the upside, or give or take a few percent, and they'll all likely follow a very, very similar route on the way down. And hey, again, I still believe the metaverse is the trend of 2022. I still think it's early. Maybe it takes some time for us to rebuttal, but overall, this cycle will apply on the next wave and the next wave and the next wave. And you see this happen every time whenever there's a hype cycle or bull market, okay? So just keep that in mind. Again, screenshot this, you guys. Again, you really don't need to just keep looking at this. It's just the general, it's the principles of this. And again, things can happen very fast, and you just got to be realistic, okay? Stay rational, be as realistic as you can. And again, that's very important for longevity. So let's quickly take a look at this. This is large cap versus small cap stocks. Very self-explanatory, right? Large cap versus small caps. So interpretation, which performed better in recent years, large cap or small cap stocks, differentiating these characteristics in a popular way to segment the U.S. stock market. The term cap refers to the market capitalization and is calculated by multiplying the price of the stock by its number of outstanding shares. That was all obvious, almost unnecessary to read that, but just in case you guys needed a reminder, large cap means the market cap is larger. Think Apple, Tesla, $1 trillion, Amazon, multi-trillion dollars. And then small cap, Vuzix, $500 million. That's the first one that came to mind. SoFi, $10 billion. Plug Power, $16 billion. Just names we've been talking about. These are small cap stocks, okay? So as you can see here, this is large caps versus small caps, and large caps are reaching a pretty high level. Let's go to 5 years so we can see some historical data. So constant climb. You can see that large caps really took over in 2020 over here, and since then they did take a tumble. This is right here. This is February, March of 2021. As we mentioned earlier, this was the peak. This was the lowest it's been in years, where small caps really started overtaking large caps, okay? And that was the good times. That was the good times. That was the Riot blockchain times. That was all the EVs, green energy. Everything was ripping, seeing their all-time highs. And now, again, almost all of the names that gave us such rewards back in February, March of 2021 have seen like 70-80% corrections from their all-time highs back in those months. Okay, so that's the low over here. Since then, we have been on a constant climb, and right now things are looking pretty damn good. Like, this is very organic growth, which is kind of the argument against, hey, maybe it will take some time for small caps to make a comeback. But again, this level historically is high. You can see that it like just looking at this, I don't know what the exact ratio is here, but you can see the levels we're at now are at the highest, are at much higher levels than they've been since 1980. Okay, so that's important to keep in mind. That's what gives me an inclination that probably we will see some sort of correction and once again reversion to the mean for these small caps to play some catch up to the large caps that have been absolutely dominating. So pretty much speculative stocks versus value stocks. Okay, so I do think there will be a cyclical rotation and a reversion to the mean from large caps, which are, again, your Apples, your Amazons, your Teslas. They've just been seeing so much freaking upside lately, to the small caps that have been getting beaten down for the past 8 months. Okay, so 8 to 10 months, I guess. So we're coming up on a year already since a lot of those all-time highs. So this right here is a kind of a better visual. Just the black and orange lines are large caps, and these ones are micro caps. Okay, so black, orange, larger caps, and then these colored lines below are the small caps. Okay, and you can see right now we are definitely forking off, right? Falling each other pretty much to a T up until, of course, last year when the small caps finally caught up to the large caps, saw a big jump. But since then, again, over the past 8 to 10 months, we have seen that diversion. Okay, they're splitting off. They went on two separate trails, and I do think to some extent, again, it's not a matter of if, it's more when. I do think that small caps do just have to play some catch up at some point, and I do think that these will find some sense of normalcy. Just again, historically, when you look at these, small caps and large caps typically move in tandem, and that is way more. That it just doesn't look right. That looks off, and I do think some sense of normalcy is going to return. Okay, and again, I don't know exactly when. It's very confident it's going to happen, just historically speaking. But again, it's a matter of when, not if, in my opinion. Okay, so that's that. Let's read over this to get to close it out with some fundamentals. Talk about the race hikes, and then we'll call it a weekend. Okay, so why is thematic tech, cryptocurrencies, cybersecurity, clean energy, cloud computing, and all the stocks beloved by ark's Cathy Woods, shout out Cathy, having such a tough time? It's not hard to figure out. It has to do with multiple compression. What moves stocks? Jack Bogle, the founder of Vanguard and the man who had the most influence on the way I look at an investing world, used to say that there were three components to the total return of a stock. 1, dividend growth or shrinkage. 2, earnings growth or shrinkage. And 3, the multiple expressed as a PE ratio, price to earnings ratio, which shows how much investors are willing to pay at that moment for a future stream of potential earnings. If we accept this explanation, then what part of these three factors is causing all the names to move down so dramatically in the last few days? So, in this article, the guy uses these as the examples. You would know these are all pretty household, smaller cap names, I guess, like speculative risk on names. But again, this applies to the entirety of hyper-growth sectors within the equity markets and cryptocurrencies as well, okay, just from a principles perspective. It's not dividends. Most of these companies pay no dividend at all. Is it earnings worries? It's possible that investors are beginning to believe that the earnings of some of these companies will not be as strong in 2022 as anticipated, but a week seems like a fairly short period of time to make that decision. Again, speaking to the fact that there isn't much rationale present in the markets, there's a lot of fear, okay? Extreme fear, very extreme fear, okay? The most likely answer, is multiple compression. The PE ratio of these companies, those that make money, are dropping because investors believe it's more risky to own them in a higher interest rate environment. Moving on to interest rates. This is the key macro factor, the real wrench in the gears that is coming into play right now, okay, and tripping everyone up. Why is multiple compression happening? It has to do with the Fed and JP raising interest rates. The cost of money. There's a simple rule in finance. When money is free, people throw it around more. When the cost of money goes up, people get more cautious, which again, you guys, when in all of our macro analyses in the past, we always talk about the DXY, the Dixie, or the US dollar index. This is the US dollar relative to a basket of other international fiat currencies. This shows the strength of the US dollar. And when the dollar is strong, when the dollar is in high demand, everything that trades against the dollar, this is, again, you guys, this is, I'm just explaining this, but it's very obvious. When everything trades against the dollar, right? The U.S. stock market obviously trades in U.S. dollar terms. And when the dollar gains strength, it creates weakness within the equity markets, within the crypto markets. Any market that trades against the dollar is weaker when the dollar is stronger, okay? And that's pretty much every single financial instrument on earth, considering the dollar is the global reserve currency, okay? It's really that simple. Whenever you buy a risky asset like a stock, it is compared to a risk-free rate of return, which is usually treasury bonds. Again, treasury bonds, although they provide low returns, it's a guaranteed return, okay? It's a guaranteed return. Think about it. If you can buy a 10-year treasury bond that pays you 1.5% a year risk-free, you had better be convinced you can get a much better total return than 1.5% if you buy stocks. Otherwise, why bother? So again, bonds are going up right now, but I think this is just panic following the rates raising announcements. And I think straight up, I think you're a fool if you think bonds can return more than stocks over the next decade, okay? Especially in this revolutionary time period where technology and biotechs, again, everything is evolving at such a rapid pace. You're a dinosaur if you think bonds will return more than stocks in the next 1 to 5 years. Here's the rub. Higher rates can hurt equities because depending on how much rates move up, there's a more attractive alternative. The 10-year yield goes up from, say, 1.5 to 3%. Bonds may be more attractive for a certain group of investors. The 10-year yield has moved up about 25 basis points this week alone to about 1.75%. But why would speculative tech stocks, particularly those that have high multiples and make very little profit, be particularly vulnerable to higher rates and a more aggressive Fed? Quote, when risk gets more elevated, the first thing that gets sold are riskier assets. We've said that many times. That's obvious to a lot of you. And one of the characteristics of riskier assets is that they often have higher multiples, according to Nick Raish, who tracks earnings at the earnings sale. Where does it stop? So I don't necessarily agree with these last couple paragraphs, but I'll give you guys my thoughts on this and when things will stop, and then we'll call it a day. All right. For Alec Young, Chief Investment Officer at Tactical Alpha, the main concern now is to see that if the contagion spreads to the broader mega cap tech universe, these stocks have more stable earnings and far lower multiples, though many are still elevated compared to 2019 levels. The speculative Cathy Wood stuff peaked a year ago, he told me. What you want to watch is if investors move up the quality scale and start selling Microsoft or Adobe. It's all keying off inflation and the Fed. It feels like bond yields want to move higher, and if this happens on top of persistent inflation, a lot of people may step away from the market. So this is the one sentence I agree with here. So I mean, none of it's wrong, but I think this is kind of a weak answer. Like, I don't think there's much detail here, and I don't think there's much meat in this answer. But what has happened, just again, this is just my thought, this is my 2 cents. What has happened over the past couple of months, and I've seen this amongst you guys in the YouTube community, there's a lot of you who are upset, and again, rightfully so. It sucks to lose money. But again, that's just the game, and that's how it is. But unfortunately, because so much retail investors, so much young capital, so much new capital enter the market back in 2021, 2020 moving into 2021 with the pandemic, with all these growth stocks just absolutely mooning. Dogecoin, Shiba Inu, perfect examples of kind of this bubble that was being created amongst absolutely no value mania, like the quick cash. Everyone who wanted quick cash got in the markets, and all of those kids, all of that youth, not just kids, not necessarily like younger individuals, but just any newer capital, anyone who is a newer face to the markets and trading, etc., has lost a lot of their money. And a lot of them maybe didn't have that money to lose. A lot of people are using leverage, and unfortunately, there is a lot of retail interest that is no longer present in the markets because they can't afford to be in the markets anymore. Okay, and that is the transitionary period that we're going through right now. A lot of money that was once in the markets, that was deploying capital within the markets, literally doesn't have any more capital to deploy. Therefore, there's just less capital floating in the markets, and a lot of the institutional money that will obviously stay in the market and circulate through the markets is going more to value stocks than growth stocks because they're just safer plays. But again, looking at the disparity between large caps and small caps, I think it's only a matter of time before institutions, retail investors start to hop back in because things have just gotten so beaten down. And that's the big question, okay, you guys? And I do think this will happen once a lot of the dust settles. As I mentioned in this bad boy, I just feel like it can't get much worse from here. I feel like the majority of individuals who would have sold their growth positions that are down 60, 70%, if you haven't sold by now, I feel like it's pretty damn unlikely you're going to sell. Please let me know in the comments down below what your thoughts are on this or anything we've talked about, but specifically this. Have you sold many of your growth positions and gone into safer positions? Because maybe that is happening. I'm personally not doing that. I'm holding these positions. There's no chance I'm selling a lot of these names that I believe so heavily in longer term from a fundamental perspective. And again, you guys, that's just my style. I'm not necessarily trying to play... I'm not even chip makers. I'm not trying to play AMD, NVIDIA. I'm not trying to play Tesla. I'm not trying to play Apple. I'm going for these 5, 10x over the span of months or years or bust. And that's just my style. And hey, maybe you missed some, but you guys know, like the rule of fives or the rule of twos, threes, you can go on any multiple. If you were to say take 5 bets on 5 small cap companies, say these companies each have $1 billion, $1 billion market cap. If you were to take 5 bets on these 5 small cap stocks, you've done your DD. Of course, don't just spray and pray. Do your DD. Take 5 bets that you think can 5x in the span of just say a year. Okay, really going hard. If by the end of that year, one of them hits the mark and does 5x like you expected it to, you break even. If 2 5x, boom, you double your money. 3 5x, you triple your money. And that's just the rinse and repeat cycle that I personally take as a trader, and that's just my style. Of course, you guys, styles vary. Always find your own lane, find your own style. Maybe you're just a day trader. I'm absolutely not. I'm very passive. Go jump in the water right after this. I like to just pick my horses know the potential they have from a fundamental and operational perspective, know they can scale, know they're on the right track, and take those bets and just kind of chill for the most part. But stay excited about them. That's why I keep making these videos, and that's why, you guys, I'm not worried. I'm not worried. It sucks. Again, weeks like these, months like these at a time suck. They can get in your head. It can damage your psyche. But you got to stay strong. You have to stay emotionally resilient, because ultimately in the long term, if you want longevity in this game, you need that emotional fortitude. You need that resilience. You need that thick skin. So keep the skin thick. Heads up, soldiers. Always stay on, and yeah, stay strong out there, okay? So have a great weekend, you guys. I'll catch you in the next video. Until then, Go drop a comment as well. Give the video a like. Didn't even ask for that. Like the video. Subscribe to the channel. If for some reason you're not watching and you're not subscribed, subscribe to the channel. Help your boy get to 50K. And if you're still watching, I appreciate you. This was a long one, but this was a fun one. And nice and relaxed one to make, to be honest. So appreciate your guys' time. And yeah, I'll catch you guys downstairs in the comments. Till then, always remember, take action. Make waves. Peace, guys.